Hello, welcome to this online session from Impact Taxation and Financial Services. In today's session, we'll have a look at the tax impact on interest rate increase. Okay, before I go to the main content, the information provided here is for general information only. Before making any decisions, please contact an experienced tax agent. Okay, so firstly, let's have a look at what is a good debt and what is a bad debt for tax purposes. Okay, so good debt is tax deductible, all right, and then the net loss on interest increase is based on marginal tax rate. So the real impact on your cash flow is actually the interest rate increase multiplied by 1 minus your marginal tax rate. So we'll have a look a little bit later on the calculation and the real impact to you in terms of dollar value. Okay, so bad debt for tax purposes is when is used for private purposes and is not tax deductible. Okay, so before we look at the impact, we need to understand whether the debt you have is a good debt or bad debt for tax purposes. Okay, and then let's have a look at a few examples. Okay, so basically, okay, good debt is used to generate taxable income. That's why you can claim the interest as a deduction. Okay, so a few examples here. Loan on investment properties, because you're earning rental income and it's a taxable income, so you can claim interest deductions. Debt on motor vehicle used for work purposes. So when you are using logbook method, you can actually claim a portion of the interest as a deduction, okay, depending on the logbook percentage. And cost of finance on other investments, for example, shares, cryptocurrency, etc. And then business loans, yeah, if you have a business and you have to borrow for the business purposes, that's also for your business income. It's taxable. Then you can claim the interest deduction. Okay. Then part of main residence loan, if a portion of the property is used to generate taxable income. So say for an example, if you can or you rent one of your rooms out to a tenant and you're generating rental income from that part of the house, then you can also claim a portion of your interest, yeah, as a deduction, tax deduction. And then also similar scenario, if you have a home office, yeah, you run a sole trader business from your home office, and then for that one room, you can also claim interest deduction, yeah, as a proportion, yeah, of all the total interest you paid for the house, for the loan. All right. So what are some examples of bad debts for tax purposes? Okay, so loan on main residence, and it's not used to produce any taxable income. Okay, so you don't have any taxable income, so you can't claim any deductions. All right, or cost of finance for motor vehicle used for private purposes only. Yeah, because it's for private purpose, so you can't claim any deduction because there's no taxable income. All right, in the same token, if you have private loans, you don't generate any taxable income, then you can't claim the interest deduction as well. Okay, so next, let's have a look at the real impact on good debts. Yeah, for bad debts, for tax purposes, unfortunately, the amount of interest rate increase, you have no other ways to reduce it. Yeah, that's going to be your real cost increase. Okay, but if in case you have any good debts for tax purposes, the interest is going to be depending on the marginal tax rates, depending on different entities. So say for an example, the after-tax impact of $1,000 interest increase will be $655 for an individual with taxable income from 45K to 120K. So, of course, this bracket is for people whose income tax rate is 32.5% plus 2% Medicare levy, so it's 34.5%. Okay, So minus tax, 34.5%, you have the remainder of the interest. Okay, that's the part that you have to pay after tax. That's your real after tax cost. And then what if someone's marginal tax rate is 47%, the top marginal tax rate, then it's going to be 47%, okay, $530. Yeah, that's a real after tax cost. Yeah, after the we factor in the tax rate. Okay, so then of course sometimes people look at the interest rate increase, they're panicking. Okay, I have to pay $1,000 every month. That's going to be more interest I need to pay. But the reality is after tax, your real cost could be only $530. Yeah, if your top marginal tax rate, really high income earner. All right. And then so it's going to be $750. Okay, if $1,000 is going to be the tax or interest increase after tax for a base rate company. Because the base rate company, the tax rate is 25%. Yeah, that's applicable to probably 99% of all Australian companies. Then the real cash flow impact or after tax impact is $750. All right. And then it's $850 for self-managed super fund, because under SMSF, the tax rate is 15%. Okay. And then it's going to be different for family trust because of distribution to different beneficiaries. All right. Yeah, I hope this is making sense. So when the interest rate increase, if you have good debts, you can panic, but you shouldn't panic 100%. Okay, so at least you need to remove the tax portion first, because the tax will be your saving on the increase. All right. Okay. So then yeah, I want to mention a few things on how to manage your debt. Okay, so for tax purposes, purely when you're looking at how to reduce your tax, you want to maximize your good debts, okay, and minimize your bad debts. So that means okay, I actually left an example here, so it's probably could be a typical example. So you can check our YouTube video, should you buy or rent your home or both. So for this one, we actually give everyone a possible third scenario, which is you actually rent your home and then you buy an investment property. So by doing that, because for your rental property, you can actually claim a deduction, okay, for on interest, water rates, council rates, depreciation of the property potentially. So that means it's actually definitely a good debt. Okay, so when you're buying a property as main residence, you're living in there, because it's going to be used for private purpose, so there's no tax impact, or you can't claim tax deduction for the interest. Yeah, but by you renting and live in a rental property yourself, and then you buy a property and lease it out to a tenant, then you can actually utilize all the deductions on that investment property. So that's like a typical scenario that you are maximizing your good debts. Okay, when we're only focusing on tax purposes, of course. Of course, when you buy, you need to look at the market and understand which area or whether it's worthwhile for you to buy. And then consider your own financial situation as well. Yeah, so we're just talking about tax here. And then also when you pay down bad debts, you want to pick the ones with highest interest rate first. Okay, this is a little bit like financial planning strategy. So you want to, if you have multiple credit cards, for an example, your private credit cards, you want to put them next to each other, yeah, and pick up the one that's giving you the top interest rate. And then you want to, if you have any surplus cash, you want to pay that one first, and then slowly going down to the debts that's paying less interest rate. Okay, and then a special note here that's very important. A lot of people don't know. With help debt, okay, help debt is actually interest free. Okay, so it's contrary to a lot of people's, it's a misconception. Yeah, they thought, okay, there's an interest added on top of it, but it's actually interest free. But the government does add an indexation on the top. So that's actually based on CPI, based on inflation every year. I think at the moment, this year is probably 3.9%. So if you have a home loan that's probably still lower than your home loan rate, you might want to pay back your home loan first. All right. And then, of course, health debt is compulsory based on your tested income level. Yeah, it's actually not purely your taxable income. It's also you need to add back some other income, yeah, other or loss on rental properties, for example, you need to add it back. So it's actually adjusted, yeah, tested income. And then, so if you have to pay, you have to pay, you have no choice. Yeah. But if you don't have to pay, don't pay back too early. Yeah, it happened quite a few times. Sometimes a client asks me, oh, I still have how much left in my health debt? Should I just pay it off in one go? I normally would ask them, do you still have a home loan? Home loan. What's the interest rate on your home loan? And then, yeah, then I actually help them to do a comparison. If you don't have to pay back your health debt, don't do it. So because you want to pick up the loan, you're actually paying higher interest rate first to pay back first, and then slowly going down to the ones that you're paying less interest rate, yeah, or you're paying a less cost. Yeah, so the cost of health debt is just the indexation or inflation rate. All right. Okay. So then that's the end of this presentation. Here is a brief introduction about myself. Our contact details are here. If you have any questions about this topic, let us know. Drop us an email or send me a quick message. Yeah, so thank you for attending this session, and we'll see you in our next session.